All right, everybody. If you were in class last week, you know that we worked quite a bit on this case study about the 25-year-old single individual living in Connecticut, making $65,000 a year in wages. I realized that the recording I posted ended just when we were about to start the group work on this problem. And I also noticed that we didn't quite fully explain the tax computation that was part of the second part here. So I'd like to just go over this part one more time so that you have a better grasp on what we're doing, because we are going to talk about it a little bit more on Monday, and it's also going to be part of your midterm that you take early this week. So for the gross income, the formula is provided. You're just going to add up the wages, in this case, the interest earned in the savings account and the game show winnings. Okay, that's all that we have for this individual. For the adjusted gross income, we take the answer from step one, which is the gross income, and we just subtract what we contributed here to the tax deferred savings plan, because it's the only adjustment that we're making. Next, we have to figure out what the taxable income is. And in order to do that, we first want to decide if it's better to itemize or take a standard deduction. So in our case, when we looked at itemizing, it meant adding up, in our case, the mortgage interest, the property taxes, the state taxes, and the charitable contribution. Now we found that this sum exceeded the individual, the single here standard deduction, which was $12,200 for 2019 and is $12,400 in 2020. Either way, we got an amount that was greater than that. I won't share the amount. I would like you to calculate that on your own first and put it in your notebook. At the end of the day, we discovered that our taxable income was exactly $45,500. So now our job is to figure out what tax we actually owe. So first, that involves a tax computation based on the tax bracket. In our case, the $45,500 puts us squarely in this income range, the 22% tax bracket here, as an individual taxpayer. So now to calculate. We see that if we are falling in the 10% bracket, right, we at least pay $9,875. We at least have $9,875 in taxable income. So multiplying that by the 10% gives us $987.5. Okay, so that's our first amount that we find. The next part, we're going to subtract the upper and the lower limits of that interval, and we find that when we subtract those two and multiply that by 12%, by 0.12, we get $3,630 that we owed. And then the next row, which is where we're going to stop, because again, our taxable income falls right into this range here. So we subtract our max minus our min here, the 85,525 minus 40,126, and we're going to multiply that by 22%, so 0.22. And when we do that, we get 9,988. So these are the three amounts that we are now going to total. When we add those up, we get $14,605.50. However, remember that this individual had an American Opportunity Tax Credit. So we're going to subtract that from this total that we found to compute the tax that's actually owed. So this is our tax computation. This is our tax credit. And so the tax that we actually owe is $12,105.50. Okay, I think that this is a good exercise to try on your own. So my suggestion is for you to try the following. Assume the taxable income of $100,000 and that the person filing is a head of household. Now calculate the tax owed. Assuming no tax credits. So there will be nothing to subtract at the end. All right, so try this one on your own, and we'll start Monday's class with the answer to this one. Thanks.